Hi, this is Alvin, the CEO of Dr. Wealth, and today I'm going to share with you something about PE ratio and its secrets. So PE ratio is a ratio that most investors would first encounter when you are learning how to invest in stocks, how to analyze stocks, how to do valuation. So usually PE ratio is the very first one that everybody learns. And although it seems simple, but PE ratio is not a silver bullet that can solve all your investing problems after you have learned about it. So PE ratio is just one of the many aspects that investors can use to look at a stock, to analyze, to value a stock. Okay, but there are cases where PE ratios are totally not useful at all. And when can we then use this PE ratio and use it to its maximum effect? So that is what I'm trying to tackle in this video itself. So let's hit the road. This is how the PE ratio is calculated. So PE ratio is just very simple in terms of its calculation. And the numerator is just share price. Alright? Just take the share price, and then the denominator is this metric called earnings per share. Although it sounds like a jargon, but it is not something that is very difficult to understand, because at the end of the day, the earnings is the net profit of a company. Right? They call it earnings sometimes, they call it net profit in other times. So earnings is what actually is the bottom line, ultimately how much the company is making via its business. Okay? But earnings can be a very big number. It can be in millions or even billions of dollars, which is not useful when you compare to the share price. So you need an apple-to-apple comparison, because share price is the price per share. So we need to divide the net earnings or the net income or the net profit by the number of shares in the company, and then we'll get earnings per share. To make things more complicated, sometimes the computation can be using a basic earnings per share, which is usually the default, or sometimes it can be diluted earnings per share. The difference is that some companies, they do have options that can be exercised, or some convertible securities that can be exercised into shares, they can be converted into shares. That means that once the conversion is done, the number of shares in the company actually expands. And that means that using a diluted earnings per share would be a more conservative measure for the earnings per share, rather than using the basic, which doesn't consider the conversion of all these securities. So how you compute this is also a subjective matter, right? So different websites may show you different kind of PE ratios and different kind of computation. You have to understand that what are differences that lies in all this calculation. But basically, a PE ratio is simply just comparing the price versus the value. Okay, this is what Warren Buffett says. Price is what you pay, because this is what you're going to pay in terms of buying this stock. The share price is what you ultimately pay for. But what you're going to receive back is in terms of the earnings, right? For companies where they are making positive earnings, and ultimately where earnings is the most important measure of this company's business, then yes, okay, that is the value you're trying to extract out from the investment into this business itself. So that's PE ratio. Price is what you pay and value is what you get. And another way to look at it is that sometimes people look at, okay, this PE ratio is 5. What does that mean, right? So is that good or is that bad? What an explanation for this 5 can be is that it takes 5 years for the business to earn back the price you invest today. Okay, so for example, a PE ratio can be derived by having a share price of $5 and an earnings per share of 1, right? So your PE ratio is 5. What this means is that if the company is able to make $1 net earnings per year over a span of 5 years, which is P5, you would have made back the price you pay for the stock. Okay, so there's another perspective that you can make sense of that number when you see a PE ratio. It means how many years is it going to take for the business to earn back the share price you pay for today. Okay, so that is essentially what PE ratio stands for. Okay, so next one we want to talk about is that there can be many PE ratios. Like what I told you just now, there are many websites who give you this PE ratio readily, but it doesn't mean that the PE ratios are the same, because on one website maybe it says PE 5 for this stock, and then for the same stock in another website it says PE 10. So who is correct? And then you look at the third website, it says PE 8. It could be they are all right, all correct, just that because the way that they calculate it is different. And what kind of PE ratios are we talking about? In general, there are only two main types of PE ratios. but if you dive deeper, there can be many beyond just 2. I show you over here is 3, right? But basically there are 2 types. Okay, the first type is called trailing PE ratio. That means it's looking at the historical PE ratio. I'll come to the historical PE later, but let me explain the trailing PE first. So this trailing PE means that it's taking probably the last 12 months PE ratio. Maybe now we are at quarter 1, right? So they take quarter 1, quarter 4, quarter 3, and quarter 2. So 3 from the previous FY, and then 1 from the current FY that just passed. Okay, so it can be something like this, which contribute to the earnings per share that we talked about just now, the EPS. To get your PE ratio, you need to divide by the EPS. And trailing means that you take the last 4 quarters or the last 12 months of earnings, and that goes into the denominator. And you take the current share price and divide by this last 12 months earnings per share. That's get you your trailing PE. Okay, so that is based on history, what has passed. And forward PE is the second type. And forward PE means that you are projecting forward. So maybe you're at quarter 1 now, and then you have analysts who project it for the next 3 quarters, which is still the current FY, and then maybe quarter 1 of the next FY. Okay, so same thing, these 4 quarters will make up the forward earnings or forward EPS. This is based on projection, this is not based on historical facts, right? Which means that different analysts may have a different kind of number of projection. Okay, some may be more optimistic, some may be more pessimistic. So it depends on how the analyst does it, and it also can be a consensus. That means averaging out what the analysts think. Okay, maybe an average of the 10 analysts forward projection. So you take this forward EPS, again you plug into the calculation, the ratio over here. So instead of using a historical EPS, you're using a forward EPS. And same thing, you divide by today's share price and see what is the forward PE you get. So there are 2 types. One is more historical, one is more forward looking. Okay, it's not that one is better than the other. It depends on the nature of the business. If let's say this business tend to have some element of growth, right? It is actually more of a growth stock than just purely a value stock. Then using forward PE makes more sense. But if let's say it is not really a growth stock, it is just stagnant or stable, it's not really growing, then trailing PE would make more sense. Okay, because past numbers are already indicative of today's value, right? It's not about futures value. And when we talk about historical PE, what is this role, right? Since I say trading is already historical, what is this historical then? So historical, usually it cuts off at the FYM. Okay, so maybe the FY, it's from quarter 1 to quarter 4. Okay, although we are at quarter 1, we have a new quarter of EPS for that quarter, but we just take the last 4 quarters from the previous FY. Okay, so regardless of how many quarters have passed of the current FY, you don't use the new PE ratio until the whole FY is completed. So which means that historical PE in this aspect tends to be more delayed, right? It tends to be more outdated than the trading PE, which updates by the quarter. Okay, so these are the different. So now you understand that PE ratios can have different calculation, different periods that we are looking at, which means that when you compare between websites, you need to find out how do they calculate this PE ratio. And sometimes the differences are warranted because they are looking at different periods. Okay. Next one, let's dive into the secret number 1. When is PE ratio useful? So PE ratio is only useful for profitable mature companies. What do I mean by that? I show the table here. This is taken from Professor Damodaran. Right? He's known for a lot of these valuation techniques, and I like the way that he grouped these stages of the company's life cycle. So stage 1, usually we don't care about them because stage 1, these are usually private companies that retail investors don't really get to invest in unless you know somebody who is doing the startup. Is based on relationship basis that you get a chance to invest. Other than that, usually startup, you don't get to invest. And stage 2 companies are companies that may already be listed already. Okay, so this is likely the earliest point where a company can go listing, and it's still young, right? Then stage 3, the growth rate slows because it's getting more and more matured, And stage 4 definitely more mature than stage 3, and so on and so forth. Okay, until stage 6 is actually going the opposite way, which is decline. And stage 5 is the stable period where it stopped growing. Okay, so why am I showing you this? Because PE ratio is not useful for many of these stages. PE ratio is only useful in stage 5 and sometimes stage 4. Okay, depending on how important the growth is, right? But majority of the time, PE ratio is more suitable for stable or matured companies that don't really grow that much anymore, and it is profitable. Okay, it is profitable, right? I show you over here, this is operating profit, this is not net profit. Operating profit is somewhere higher up, earlier than net profit, but it will give you some indication. If the operating profit is not even positive, then very likely the net profit isn't positive at all. So for example, your stage 2 company is making losses, so they are not profitable, right? Stage 3 may be profitable at the operating level, but not at the net profit level. Stage 4 likely to be profitable, right? But can be a marginal kind of profits that we're talking about. But by stage 5, the margin should be quite stable and quite healthy, right? And that's where PE ratio is the most useful. Okay, so predominantly stage 5, right? So I want to give you some examples. What kind of companies are we looking at? What kind of companies are we talking about when we are looking at stage 5 companies? So one example is that they can be in mature sectors such as finance sector, right? Banks, insurance companies. These are companies that don't grow a lot, right? You can see that this is, let me locate their revenue, right? This is the line. Okay, you can see the revenue is not like very, very high growth. Okay, in fact, there was a dip. Okay, there was a dip. And then after that, it just have a slight growth from there. Okay, so which means that based on what we see these 3 quarters, right? The growth rate is not really there. Okay, for these kind of companies, they are likely the stage 5 companies where their growth rate have tapered off. Okay, but they are very profitable, right? As you can see, their net earnings is all profitable throughout the quarters. All right, and it's quite healthy profit margin, right? You see these net earnings about 4 billion, while they're thinking about 13 billion. So that's almost like a third. Okay, 30% profit margin. So you can see that typically this is the kind of stage 5 company we are looking at. They don't grow much. Okay, they don't need to reinvest in the business much. That's why they can give more dividends. And we haven't looked at the free cash flow, but generally from the income statement, you will get an indication which stage of this company is at, comparing the growth rate as well as the margins of the business. Right? So PE ratio is only useful for these kind of companies. Okay, where they are not really growing, where they are margins are stable and healthy margins in fact. Right, then PE ratio becomes the very key thing that you can look out for in terms of valuing the company. Another example, oil and gas, ExxonMobil. This is a company that I guess most of you will know. And we look at their, this is not quarter, this is yearly results, right? From 19 to 2021, you can see that their revenue is fluctuating because this is more like a cyclical company. And of course, because of 2020, we went through COVID, there was a period where demand just went off totally, right? And not say totally, okay, a good part of it, because travel is down, production is down, a lot of things are down, and oil price even went negative, right? So there are these kind of sectors where they are mature, but they tend to be cyclical as well. Okay, later I'll share with you in more detail, right? There are periods like this where PE ratio can be distorted. Okay, for example, they make a loss, right? But other than that, you can see when the times are normal, okay, back to normal, their profit margin should be there, right? And during a boom period, of course, your profit margin can improve further. But you can see this is also another example of a stable industry sector company, okay, where they don't grow much, but their margins are healthy during normal times, because this ExxonMobil tends to be a cyclical kind of industry. The third one, Coca-Cola, consumers, I believe they classify as more discretionary rather than a staple. Okay, so this kind of companies, they are less cyclical because during bad times or good times, people consume them. Okay, and you can see that their revenue growth again is not very fantastic. Okay, although there's 17% growth, right? It's still quite decent. But you can even compare across the years, maybe 3 years, 5 years, kind of average annual growth rate, right? You will see that probably sub 10. Okay, maybe growing as fast as what the GDP is, which in US is about 2-3%. And those cases where the companies like this would not grow as fast as a lot of other younger companies. So these are the mature companies that we are talking about. So that should give you some idea, right? What do I mean by stage 5 companies? And you can see that again, they are profitable. Okay, they're profitable. All right, and their margin is also decent. Okay, so in this case, it's also about 25%. It's about 25% or so profit margin, right? So these are the kind of companies where PE ratio will work well. All right. Now let's move on to when your PE ratio is not useful. Okay, so the problem is with PE ratio is that there are more instances where PE ratio is not useful than instances where PE ratios are useful. Okay, so which means that PE ratio, you must know when is the right time to use it, and it's not always, in fact most of the time it isn't useful at all. You'll be applying on the wrong stock and drawing the wrong conclusion. So this is something that I think a lot of people don't understand, and they think that PE ratio is something that's applicable to all kinds of stocks. Okay, unfortunately, it's only for a particular type of stock, which we covered previously about the mature profitable company. So PE ratio, why is it not useful? When is it not useful? Is usually for obviously non-profitable stocks. They tend to be more high growth in nature. Sometimes they can be profitable, but they are still high growing. Okay, I'll give you some examples later. And lastly is the decline stocks. Okay, so basically, just like I told you that stage 5 is the one that you can use for PE ratio, right? And some in stage 4, but let's assume that let's not use it for stage 4, right? So no, because these are growth stocks. Okay, so these are growth stocks. So when growth is more important, the valuation tends to favor those with high growth rates. Earnings is not as important, right? So which means that what is the main value proposition of a stock? Okay, if it's a growth stock, unlikely earnings is important, right? But if the growth rate slows, then the share price will get affected. If the growth rate continues as per normal, as per expected, then this kind of stocks will maintain its valuation, right? Maintain its share price. And in fact, if it grows faster than expectation, the share price can go up a lot faster. So then you understand that for this kind of growth stocks, what is more important is the growth rate, not the earnings. And if it's not the earnings, then PE ratio, which measures the earning, is not important. All right. So stage 2, 3, 4 kind of companies, usually PE ratio is not as important as compared to stage 5. And stage 6 is also not important. The reason is because it's in a decline stage, your PE ratio can mislead you. It can be very cheap, very cheap, very cheap. You buy, but end up the share price keep going down, and it's still cheap. What is cheap become cheaper. I will give you an example later, and you'll know why it is dangerous to use PE ratio for a stock that is going in a decline stage. Okay, so let's give you an example on a high growth, loss making kind of company. Snowflake, this is a stage 2 company, growing fast. You can see double, right? More than double the revenue. Okay, 100% revenue growth. That is very fast, right? Coca-Cola is not doubling. Goldman Sachs is not doubling its revenue in a year, right? But this kind of stock is doubling its revenue in a year. Okay, so that is how fast that we are talking about, and yet it is still making losses, which means that when your E is negative, you get a negative PE ratio, and the negative PE ratio is in fact non-applicable, right? So this is a very easy example that you will know that PE ratio cannot work for this kind of company where they are loss making, even though their growth rate is very high. The P ratio, if you still forcefully apply to it, you know that, okay, this is not investable. But it may not be the case. Okay, so the more important thing is how long can it sustain its growth rate going forward. And if you are able to determine that, then that is the more important thing to look at, not the P ratio. Okay, the second one, Tesla. Tesla is profitable, but if you use P ratio, you will draw the wrong conclusion as well, right? Because I compare Tesla with other automobile makers, Toyota, General Motors, and Ford, all listed in the US. And you look at Tesla, the P ratio is 124 times. And Toyota is 9.8, 5.9, and 3.4. Right? Remember, we talk about P ratio. The price you pay is the price is what you pay. The value is what you get. So for the price compared to the value, which is earnings per share, you want the price to be as low as possible. For the value, you want as high as possible. So you want this ratio to be as low as possible, right? You want the low PE ratio as much as possible. So if you just based on PE ratio, you tell you, oh, buy Ford because it's the cheapest, right? But that is not the case because you bring in another element again. Remember I told you growth rate is important for some companies. Like Tesla is growing at 73%. And whereas the other three automobile companies show over here is 16%, 3.7%, 7.2%, uninspiring kind of level of growth, right? Maybe Toyota is still quite decent with in the teens, but the rest are below 10% per year. And this revenue growth from Tesla is so much higher, and which means that this P ratio is not good to indicate this revenue growth in this case, right? So P ratio cannot be used to compare with other stocks when the revenue growth rate is very different, right? Remember I told you, okay, secret number 2 about P ratio is that it doesn't work for high growth. Okay, you can see the P ratio is extremely high, but it's warranted because of the growth rate that we are looking at. Okay, of course, there are some other metrics that you can use like PEG, which divide the P ratio by the growth rate of the company. But I'll explain it in another video, right? Because I want to just focus on when you can use PE ratio and when you can't use PE ratio. Okay, so this is the second sub-example where growth rate is high, it is profitable, yet you can't use this PE ratio. Okay, the first sub-example is high growth, non-profitable, definitely PE ratio cannot be used. And then now I'll move on to the third sub-example, which is when a stock is in a decline stage. Okay, just to illustrate to you clearly, I break it down into 5 years of performances versus the share price movement. And this is just fictitious, this is hypothetical, but I want you to get the idea, which is more important. And a decline stage stocks is in stage 6, okay, where the revenue is going down, the business is deteriorating. Okay, that's why it's called decline stage rather than stable. Okay, so if I can draw, it's like something like this. Okay, the profile, okay, the business, the revenue. Right, so then after it tapers off and it falls down. Okay, so stage 5 is the plateau. This is where your PE ratio works. So your PE ratio doesn't work when it is growing or when it's declining in terms of its revenue. Right, this is revenue growth. Okay, so that is what the life cycle tells us. Right, so let's now look at the stage 6 kind of company. And let's say 5 years ago they were priced at $100 per share and the EPS was $10. So your PE ratio is just 10 divided by 10, you get 10. Okay. And then after that, maybe you think that it's cheap, right? You buy the stock. And next year, the earnings goes down because the business is deteriorating, but they still manage to be profitable, right? And the price went down further because the future isn't that rosy anymore, and a lot of shareholders are trying to sell off the stock and create some selling pressure that cause the share price to go down. And in fact, your PE ratio is even cheaper now compared to the previous year. It's 9. And then so on and so forth. It went $60 the following year, but earnings per share, yes, it dropped. It still have a PE ratio of 8, right? You can see the PE ratio just keep going down and down, okay? Because the price is going down faster than the earnings per share, okay? And remember, your PE ratio is this formula. PE is equal to price, share price divided by earnings per share, which means that this price is going down much faster than your earnings. Okay, so your P ratio is going down, right? It gets cheaper and cheaper and cheaper. Okay, so in this case, again, your P ratio is not useful because it fails to, again, project into the future where this company future valuation is, right? It may be cheap today, but it is cheaper the next year. It's even cheaper the next year. So in this case, it is not useful, right? Remember, P ratio is usually only useful when the business is stable, right? Not when it is moving in either direction, whether is it growing or whether is it going down. All right. Now, there are cases where even during a stable stage, which is stage 5, your PE ratio may not be useful. Okay, because there can be distortion to the PE ratio that render the PE ratio useless, especially historical trend. Right? One example is it was unprofitable in one of the year or latest year due to a temporary setback. And actually, this is an example that we saw just now, the ExxonMobil. You can see 1 year it was negative. When 1 year is negative, right, it is, let's say you're looking at the stock in 2021, okay, which is you're looking at 2020 figures, okay, because you always get 1 year delay in terms of the fundamentals. And if it's negative, you can't use PE ratio, right? Even though previous years are positive, but the latest year is negative. How do you know and how do you gauge whether this is cheap or not when the PE ratio is non-applicable, right? The PE ratio is negative essentially. So there are cases where your EP ratio gets distorted, even though it is a stage 5 company, stable company, it has been profitable, but suddenly 1 year is not profitable, you will have a problem using this PE ratio. Second, when a company sometimes have a one-time huge gain or loss. Okay, for example, they may have recorded a one-time gain because they sold a property. Okay, they are not in the property business, but they somehow have this property in an asset, and they sold off the property, made a one-time gain. And you know that this one-time gain will inflate the EPS ratio, EPS itself, earnings per share. You inflate this earnings per share, and then the price, let's say it doesn't move, which means that your PE ratio goes down. Okay, then it looks like exceptionally cheap. But this is not repeatable, because next year, missing this one-time gain, the PE ratio will shoot up again. Okay, so these are things that you must be aware of, whether these earnings include that one-off extraordinary gain. Likewise, the vice versa is true, which means that if the company is making a one-time big loss because they did a write-off, right, a major write-off of a failed investment, that will cause the EPS to go down tremendously, and then that cause the PE ratio to be very, very high. So in this case, it's also known as a distortion in the PE ratio. That extraordinary event is not repeatable. They are not likely to write off the loss in the following years. Then the PE ratio will shoot back to normal, just like a rubber band, right? You return to normal. So these are distortions that you need to look out for, even if they are a stable stage 5 kind of company. And then number 3 is that they can also go for restructuring, such as spin-off. That means they spin out a division and maybe even into a separate listed company. So instead of one listed company, it becomes 2 listed company, different entities. And that means that the original company, the parent company, will lose a part of it, and the earnings will adjust, a major adjustment. Likewise for merger, which means the parent company may acquire another company and merge into a bigger entity. Again, the earnings per share get distorted because there's a one-time big change to it. So you will realize that in cases like this, your P ratio, especially the historical comparison, will not be useful anymore. Okay, and lastly, we talk about cyclical companies, right? This is more subtle because cyclical companies, they are boom and bust. Okay, boom and bust, right? In the bust period, okay, the P ratio may show it to be very low, right? Because the price compared to EPS, the price is more exerting the more downward pressure. Okay, the EPS may be just normal, right? But because it is a sector downturn, and the price for these shares, for these stocks in that particular sector, get whacked down a lot. So their price goes down, their P ratio becomes low. Okay. But during good times, which is the boom period, their P ratio can also be low. Why? Because during this period, their results are very good, which means that EPS, their earnings per share, can shoot through the roof, and that causes a P ratio to be low. In this case, it's a very big jump in the fundamentals, right? So cyclical companies, you also have to be careful of this kind of boom and bust. Okay, their P ratio may appear low most of the time. Okay, so when you do a comparison, you realize, hey, it's low now, it's low before. It's always a good time to buy, right? It may not be, because if you buy at a boom, and this kind of cyclical companies, they will have a down cycle, and then you will realize that you pay a high price for it. Okay, so these are cases where P ratio, it's not that it's not useful, it's just that you need to be aware that this boom and bust can happen for cyclical companies. Okay, so take note of all this distortion. It doesn't mean that it's a stage 5 company means P ratio is always usable or practical or useful in such cases. Secret number 3. How then do we use P ratio when it can be used? And we talk about secret number 1, when you can use it. Secret number 2, when you cannot use it. And now we come to secret number 3 is, if you can use P ratio, how do you use it effectively? So just remember, a very important point about P ratio is that it is only useful if you do a comparison. It is by relativity. Okay, you need to compare to something to see whether this company is undervalued, is cheap, or is expensive. Okay, without this comparison, PE ratio by itself has no meaning. It doesn't mean that a PE 5 is good or a PE 100 is not good. It has to be compared with the other factors. Okay, so what can you compare with? Very common is that you compare against a sector average, right? Because every company or every business will be part of a sector, and you can find that group of companies and compare the PE ratios together against the sector itself. Another one is that you can dive deeper to pick out the competitors. If you don't want to use a sector, you can pick out the competitors and you compare the PE ratios among the competitors. Then you know who is cheaper and more expensive, like what we have done on the automobile just now. And lastly, you can also compare with the PE ratio of the company throughout its history. Okay, because the price over EPS, which is your PE ratio, this value, especially price, the numerator will change daily. In fact, it will change like every few seconds, right? Because the share price moves. And then the EPS will change quarterly. Okay, and because the numerator changes every day, which means your PE ratio, when you compute this, it changes daily. Okay, so what you can do is that you can plot this PE ratio. You'll fluctuate because the price changes every day, right? You fluctuate between the range, right? And then you know that when it's on the high and when it is cheap. So based on this historical trading range of its PE ratio, you'll know that when is a good time to buy. Of course, you buy it when the PE ratio is lower historically compared to its past. Right, so that is one, and the third way to do it. So I'll show you one example each going forward. Sector example, Goldman Sachs, which I told you just now. This is a stable company, and this is where PE ratio makes sense. This is where you can compare the PE ratio for companies like this. And this is a screenshot from Finbox, okay, because they do have a sector valuation and compare to Goldman Sachs. And you can see PE ratio over here. I just want to focus over here and not the rest of the metrics, which we'll cover in other times. And that's why remember to subscribe to the channel if you haven't already done so, because I'll be doing a lot more videos on the other metrics so that you can have a bigger arsenal of investment metrics and tools to aid with your investment decision. Right? So let's focus on the PE ratio first. And this Goldman Sachs is at 5.9 times in terms of PE ratio, and the sector is 8.2. So you know that Goldman Sachs is actually cheaper than the overall sector. Okay, that gives you some indication. Okay, it looks like this stock is cheaper. Okay, so that's how you compare. It needs to be a relative comparison. It cannot be just by itself. Like 5.9 times of Goldman Sachs, is it good or bad? I don't know, right? Let's compare the sector. Oh, it's 8.2. So Goldman Sachs is cheaper because the P ratio is cheaper than the sectors. Another example, let's bring out the peer. Right, Goldman Sachs is a investment bank, a lot of other operations as well. Okay, and we find out some of the bigger banks in US. You have Bank of America, you have JP Morgan, Wells Fargo, and Citigroup. And these are the ones that I picked up. And we can see that Bank of America is trading at a 10 times PE ratio. Okay, which is more expensive than JP Morgan, which is also more expensive than Wells Fargo, but these two are very close, right? In fact, actually these three are very close. Okay, Goldman Sachs is closer to Citigroup. So yes, in this another example, you realize that okay, Goldman Sachs looks like it is cheaper than its peers. Let's dive deeper, because P ratio cannot be made. And you can't make an investment decision just based on P ratios alone, because even when we talk of banks, their business nature may be different, right? Some may be more heavier to wealth management, some may be more heavier to investment banking, some may be more involved in consumer banking. So their business mix are very different, right? And it depends on the flavor of the year or flavor of the month, which kind of business is investor valuing more, right? So that may result in some of these differences in their P ratio. But definitely from this point of view, you know that Goldman Sachs is cheaper compared to many of its peers. For most of its peers, right? It's trading closer to what Citigroup is, and then you can dig deeper to answer why is that so, right? If you can't find a reason why Goldman Sachs should be trading cheaper than the rest, then maybe you found a gem, right? That the market is really mispricing Goldman Sachs at this point in time. Okay, so it gives you a good lead in using this PE ratios comparison. And the third one, historical, right? Compared to its own history, what is the trading range that we are looking at? So this is taken from Tiger Brokers. This is a PE chart that's plotted over a span of 5 years. Right? So this blue line over here is your PE ratio that's plotted per day basis. Okay, as I told you, because the price changes every day, so you will see this jagged movement, and then you see sometimes there's a big jump. That's because of the earnings that was being released. So when there's some earnings growth or some earnings drop, you can see these big changes, right? So that is how the chart looks like. And they also draw this. This yellow line is the median, and the red line is the high, which is usually +1 standard deviation, if you remember your statistic class, right? And then the green one is the low, which is usually the -1 standard deviation. So how you use this chart is that you try to buy whenever the PE ratio touches at least the 1 standard deviation. Okay, so this is the point to buy, right? Even now, right? Because the share price has slightly been declining, that's why the PE ratio has been declining. Okay, even give you some computation, right? So you can see this is a trailing PE, right? It shows here TTM, okay, trailing 12 months. So it's 6, and the highest was 21.84, the lowest was 7.26. So you know at 6 is actually really quite low, and the average is about 11. Okay, so it's really considered cheap in its historical trading range. So that is how you can make further assessment. So whether is it by sector, whether is it by peers, whether is it by history, Goldman Sachs is trading at an undervalued price based on PE ratio. Of course, that's where after that you bring in the qualitative analysis to figure out what is going on. Is Goldman Sachs deserve to be trading at this low PE ratio, or is it that the market is just pricing it irrationally? That is where you get your answer whether to invest or not, right? So that's how you use the PE ratio. Okay, so I've come to the end of the video, right? To summarize, we went through 3 secrets of the PE ratio. For the first secret, I told you when is the PE ratio useful. It is mainly useful for stage 5 kind of company. We went through the life cycle, if you remember, right? Stage 1 to 6. And stage 5 companies are the companies that are stable. They are not really growing very fast, but they are very profitable. The margins are stable. The margins are healthy. Okay, these are the companies that you can use PE ratios to compare. Secret number 2. I told you that there are actually more cases where PE ratio is not usable. It's not useful, especially for high growth stocks, because the value of these stocks don't come from the earnings. It's actually come from their growth rate. Okay, and also for the stocks that are in stage 6, where they're in the decline stage, where this is again not useful because the earnings are declining as well, and the share price may be declining much faster than the earnings, and that causes your stock to be cheaper and cheaper going forward. So in these cases, P ratios are not useful. I also went through some of the distortion possibility scenarios where your P ratio may not be useful as well, even though they may be in the stage 5 kind of companies, right? For example, okay, we talk about cyclical company where during boom or bust, the P ratio may persistently be low, which means that it's not useful for you. Or maybe there is a one-time big gain loss, or big gains, a big one-time huge gain or one-time huge loss that are not repeatable, that will distort the P ratio for the year. Okay, so if you want to know more, just rewind back to that part, look at the distortion again. I mentioned 4 of them. Okay, then the last secret number 3 is that PE ratio cannot be used by itself. It has to be used in conjunction with other companies, with other peers, or even with the sector, or even for its own history. Okay, so PE ratio can be used in these scenarios, right? We went through these 3 examples. Again, if you want to know more detail, rewind back to that part and look at them in more detail, and then you will know how to apply them going forward. Okay, so I hope that this video is useful, and if you like it, remember to give me a thumbs up for this video, and remember to subscribe, because I will be doing more of these metrics so that you can have more of them to use them and improve your investment decision going forward. Right? Thank you, and I'll see you